Hyper, how are you guys doing? Glad to be back with you. To be back with you is good indeed. How are you keeping? How well are you doing? We're going to be covering today why my key three indicators. There are three indicators. In fact, there's almost time for the fourth coming in a minute, and that just happened with Bank of England's cutting rates, Fed indicating they're going to cut rates, and a whole bunch of other aspects of central banker related noise that is going to be highlighting that indeed the markets are taking strain and are wanting to get some relief. Three indicators why we are going to get a steepening into the recession and why our future president, yes, our future president, he who escaped with a skim, the flukiest of flukiest moments, turning his head just to get a mere skim. That's right. You're meant to believe that, you're meant to buy it. That will be your future president for the United States of America, and why what he will inherit will be nothing like what he inherited last time, and what that essentially means for you. Yes, so let's get on with the indicators, the three indicators that you're definitely in recession, plus our bonus fourth, which I've already mentioned, and we'll give you up front first, is actual fact that the Fed has declared that they will most likely be cutting interest rates. Everybody expects it September. Some even think a double cut. Yeah, some even think a double cut. I'm not so sure they will be going so far for so long for many reasons that I've given before, which is to do with the USD Treasury markets. Who becomes the buyer if you say they are worth more, which is exactly what you're saying when you cut interest rates. But anyway, and we'll get back to that in a minute. So central banks are cutting interest rates is number four, your bonus one. But what before that? What before that? Well, one of the metals that is very industrial and indicates industrial activity is in fact copper. So let's pivot over to the charts and have a little look and see what's going on in copper. Now I'm going to take you a slow step at a time because I want to eventually end up with a chart that you're probably not likely to see very often on any other channels, but I want to work with you on it. This is copper. And generally when you have a big sell-off in copper, that is not a good time frame for the world economic environment. For example, some of you will remember that the collapse from 2000 mid-sevens, late sevens, early eights into 2009. Very, very big collapse and led to, of course, the subprime. You were on the high side over here. And then you ended up very suddenly on a low. Now that's the most extreme and obvious example, but other periods where we had inverted HVF structures, that's a hunt volatility funnel draw that we did, first in a new trend after a slap in the face like that, led to a trend of nothing but downside. Dr. Copper actually, a lot of relationship with China. Dr. Copper was Chinese, the copper trader, do a lot of building, etc. This took you into the Shanghai Accord, which was roughly 2016, when China hit the buffers after creating heat in the global economy from 2009. Everything became China, China, China. The whole world was everything about China. They were doing all the buying. It's why Australia hardly had a GFC on account of the fact that they had a big-ass neighbor not too far away that was buying up every single rock and commodity that they could pull out the ground for steel, iron ore, and many other things that they, as a resource-rich nation, had. So eventually you got that. We then had a spell of weakening with a final spiller, an absolute thriller over there. That went with, you guessed it, that special event that may not be named, that led to so many people being absolutely dumbed down and showing that they were quite capable of failing a multitude of IQ tests. And so they did very publicly and chastised you for not falling in line as well. And that was peak NADA around about March 2020. Then you got reflated on a 7 trillion gimme. Wow, a 7 trillion gimme. This is little spoken about, but there was already quite some weakness in 2022. Then we went a tiny bit higher, and you are now here. So basically every major sell-off event, a period that went from here down to there. That was the most obvious and most extreme. From here down to there was the Shanghai Accord. From there into there was CV19. That was a bit of an echo collapse. That's post the 7 trillion being made in 2022 when everything started to slow down. So I'm not going to take copper in this way because there's an inflation element to this. So you should want to divide copper by something that actually reduces the inflation, because we want it in real terms. And as you know, inflation's gone up. So the price of copper is actually probably lagging in real terms in terms of storing value, which most commodities do. Why? Because there's disinflation in farming and commodities generally. That's why they're called commodities. Commoditization means it's not a super profitable business. A whole bunch of people get in it. A lot of technology, less people, greater scale, better extraction. Farming, you name it. Mining, we get better at pulling it out and finding it, etc., etc. So what we want to do is we want to take that inflation element that's been going on to rebase it downwards a little bit more. And also we want to say, well, hang on, we don't trust the stats of the BLS and other crowds like this. We want a proxy that also takes into account the increased threat of a debt meltdown. So what tends to deal with the rebasing for inflation and debt failure in a financially running system that is clearly getting into the fag end of failure? Well, gold. Gold is doing exactly what it should do and has performed. It's gone from 200 lows at the bottom of the dot-com around 2003. 20 years later, it's 10x that, and it's at around 2,400. From 240 to 2,400 over 20 years. That's what's called correcting for risk of debt collapse and inflation. So if we take this copper price and we divide it by the gold price, we will get an industrial commodity divided by CPI rebasement and debt collapse rebasement. Remember, people leave treasuries. Where have they been leaving for? They leave for gold. That's right. That's right indeed. So if we do that, we put the gold futures in there and we say, okay, let's divide copper by that. And this is what you see instead. And this puts into perspective, to a large degree, the extent. We've got from 1999 here. I'm going to try pull this through a little bit and get it through. This shows you very, very starkly what a major pre-pump you got before the subprime crisis and what an epic dump that was. That whole event, friends, look into my eyes, look into my eyes. No need to fantasize, just be wise. That shows you the epic depression that was part and parcel of that major collapse. So I've drawn a red line through this to illustrate a little bit more about, let's log scale it a little bit, fatten the little bit up, to give you the regression analysis. In short, copper as a whole relative to gold is underperforming. That means we are losing industrial capacity for the seeking out of a safe haven in debt collapse and inflation. So the monetized metal category is becoming more important with growing influence, and the ability to build highways, homes and apartment blocks is getting less so. Understandably, given that this mega depression, super pump there, and then some subsequent dump leading to a mega depression has taken its toll on the asset that is the property classes, and highlighting ever more the substitution into monetized metals with all the insurance that goes with it. So now, if we accept that's a depression, and was quite clearly a depression, let's have a look at the key moments since and before. What many will realize, different color, that this was quite clearly a recession. From the end of the dot-com bubble into there, when we broke from above our regression line to the downside with real downside momentum, that was a recession. And the US most certainly had quite a severe recession post.com. It was very heavily based in the NASDAQ sense on the technology stocks of the time, the .com stocks, not the Mag 7 so much. And there was a major downturn overall before we began the great reflation and the super low interest rates that led eventually to the subprime boom and the subsequent bust. This was a super overperformance, and that led by a geometrically equivalent underperformance below our regression line that I'm going to call. You even had an echo recession, again coming back down. You might remember post the depression, that was subprime, you had an echo recession. They did QE1, QE2, QE3, and then it started to go QEN with a twist, and still the world didn't wish to recover, and you went into a new kind of double dip feel in 2012. You might not recall that, but that just reminded you there was a very, very dull period macroeconomically after the major subprime boom. All the banks were bust effectively and had been bailed out on an epic scale. There was massive devaluation of your fiat currency, and governments were hyper-extending to pretend in new debt, and this was not a great result for you macroeconomically. Then we had that high, again breaking down below and then accelerating down, and that was the Shanghai Accord. So that was China now hitting the subprime bust after the West did so, mainly America. Many people go, we get this with our friends, the dollar milkshake friends, all about America good, America strong, China bad. But the subprime was almost entirely American creation. We need to understand that. I'm not visiting that on my friends, citizens American. I'm talking about the banking relationship. Even the toxic debt created of Detroit securitized assets that were sold into European banks, the source was the Detroit mortgages that were given on ninja loans. The degree of fraud in the mortgage broker environment never reached those levels in the United Kingdom or in Europe at all in terms of lending. They toxified Europe and the United Kingdom and the European banks by packaging them as high yield securities and selling the virus into another part of the world. That's right. So that was peak sickness USA that got exported, and then eventually China followed and said, anything you can do, we can do, only bigger and better, building towers to the sky in the name of their property boom. So Shanghai Accord, you can see this breaking down through the regression line. That was your echo recession, and that was your .com recession. So then we get to this event above the regression line, a bounce, a sell-off, and a violent capitulation. You know this one, we've already handled it, we're pointing it out. These are major. This is not even a normal recession. That was a major recession. If you hadn't had subprime, you'd be calling that a depression. Shut down all the small businesses, my friends. Shut them down. Amazon will deliver for you anything you need. That's what it told me on the news anyway. Free adverts where they will have cauterized, totally germ-free environment, people working with gloves and masks and PPE and all of that. They will sell you your stuff, buy your parcels, stay at home and earn no money. Well, fascinating, did very well for the mega corps, not so well for small business, who is the real recruiter of people and job provider, not these mega tech companies that actually, between all the Mag 7, hire less than 1 million people. And so we find ourselves as where we are at today. The reflation from the CV19 events took us up over here. This was clearly a reversal. Remember, this is industrial effort. That's what copper is, industrial effort. Just came back from the States, Miami. Let me tell you, old highways. I love riding on these 8-lane, 9-lane highways and the 2-lane express lane and all this good stuff. Old concrete slabs that are super wobbly. You're bouncing along like this. Tire carcasses, rubbish, debris left. There's not much highway maintenance going on. There's not much new being injected since those original infrastructure projects were done. Hey, that's just an anecdote. It doesn't mean anything, but all I'm saying is you don't have the greatest airports anymore either. Love the American people. Love America. Not going to celebrate any form of death that happens to her. I'm talking about macroeconomics and your psychopathic government that is actually sending money to Israel and Ukraine, not doing infrastructure development, investment, advancement. Go to Singapore, most amazing airport. It's the first thing you see when you arrive. It's the last thing you see when you leave. Always a pleasure to visit. They understand that. That make it great. Why isn't America amongst that? The great nation that has 5 or 6 trillion market cap corporations. Why do they not have a handful of airports like that, I ask? They understand that. It's the land of Tony Robbins. It's the land of first impressions. It's the land of friendliness and awesome people. I don't know, but it ain't happening. And your government is the one that decides that. Your government decides that it's time to pay more money so that men, or maybe men, can beat up women in the Olympics. Okay, back to this. Down, rally, down, rally, down, rally. Exhaustive rally, and now we are really in a capitulation leg, guys. You are in something equivalent to what you got here in terms of a major down leg, a substitution for industrial activity for insurance from the fire, the apocalypse. Yes, the fire is coming. The debt bonfire. That's what I'm talking about. Some people now saying it's gone beyond $1 trillion every 100 days. Let's just do basic mathematics. 3.65 100 days in a year. So beyond 1 trillion, let's just leave it at the trillion. 3.65 in a single year. That's kind of interesting. That's Yoda Yellen, the granny of note that is poison pilling. And if you listen to our David Wu interview, don't forget to go to that, bang, in our watch. 75% of all that new debt is not going on long-term debt. In other words, proper can kick down the road for 30 years, 20 years. It went into short-term bills. That will take us into our second indicator, for which it's now time to go to yield curve reversion. It did invert. When it reverts, you have a problem on your hand. Let's go and have a look at yield curves in the market right now. So I'm going to show you one that's already reverted, and then I'll show you the more popular one that's yet to. But it goes something like this. US 30 years, so a long-term debt instrument minus a short-term debt instrument should normally yield a positive amount. In short, to borrow long should be more expensive than to borrow short. Why? Because compounding effect of inflation means that your money is devaluing at a quicker rate. Your money is devaluing at a quicker rate. So let's have a look at this curve. Let's just make sure we take it out of log scale and show you where we have been and how it's working. And you can see these clear reversions over here. 1989 was when you went, let's just take the eyes off a little bit. 1989, going up post the 87 crash. Then you have the reversion the dot-com. And coming back, you have the subprime, and then you just touched on the events of March 2020. Then you had the rally, and now you have had the longest version thereof. And I'm going to show you what all those text is in a minute. We're just going to get off the monthly time frame and bring it down to the weekly time frame. You've had the longest yield curve inversion on the 30s minus 2, long-term minus a short-term debt yield. We've highlighted that this is a W head, and you had this initial reversion there, boom, a small shoulder, a big W, a reversion back up, another W, a reversion back up, and then a dip down. And since then, you have been squeezy, Japanesey, waiting to break back up above the zero line. That means becoming positive again. It's when the yield curve reverts back positive that the name for the crisis comes. All this time you're waiting for the hammer to fall. That red box is on an impulsive break, and by the way, it is getting stronger. It is getting stronger in that direction. If I just take my eye off so that you can see, that's a little test down and trading up. Why would that be? Because of all that manipulation that Yellen was doing, kicking most of the debt, 3/4 of it, into small time frames, which means it comes back quickly and has to be rolled again and again and again, is part and parcel of trying to deal with the hyper-indebtedness that the United States finds it in. All this is something that Donald Trump will find he is inheriting from the blessed Democrats. By the way, gone from 3.2 to 6.7% debt to GDP. Think about that for a while. That's not the full debts. Yeah, so that's a deficit. I've got my numbers mixed up. I think that's the deficit you'll be looking at. So it's twice as bad, in more than twice as bad in total for this. So you've got a yield curve inversion on the 30s and 2s, and you're probably going to have, if I go back to the 10s, coming on the most commonly understood debt instruments, a soon-to-be break above the zeros on the 10s and 2s. The 10s and 2s breaking also to the upside, meaning that the long-term side, the degree that people wish to hold debt, is reducing, especially long-term debt, that's going to see the interest rates climb on long-term faster than on short-term. Short-term, it's safe to put some money out for a while and get it back. Long-term, with the compounding of inflation against you, more and more people don't wish to hold debt. As that happens, the price and value of that debt goes down, the required yield needed goes up. This pushes interest rates up on the long-term debt. This is what's driving the push above the zero line, and that is why you are in a collapsing state, and the yield curve, the 100% indicator for upside generally in, downside in overall markets into a recession and deepening, always comes on the reversion back. It is a leading indicator with a 100% track record. So now you have two indicators: your industrial copper rebased for inflation, your industrial copper rebased for inflation, and you have the yield curve reversion. Two indicators right there that are giving you a downside in the economic performance and a steepening, and eventually the potential name for that there recession that we are awaiting. Then what else do we have? What else do we have? Well, you'll know that currency that we so like to chase, that we say you could almost portfolio, it has had a major pullback. It's a lesser known fact amongst retail, but the Japanese yen currency is a financing currency for speculation known as the carry trade. That means Americans and others borrow in yen and they go and speculate to make higher returns than the yen costs, which is very low. It's gone from 0.1 to 0.25. So the Japanese have actually marginally upped their interest rates, just as America is thinking of marginally reducing theirs. That is a reduction in the delta from both the top and the bottom being priced in, and this has caused scare, risk off, and fear, and an unwind of the risk-seeking trade, which is borrow yen, speculate in dollars elsewhere, anywhere in the globe. So what you're seeing is a steep pullback in the USD JPY that represents stress in the yen financing carry trade, which says risk off instead of risk on, as is normally the case in a confident environment where the yield can be expected to be broken. You can achieve a higher return than the 0.25% as stipulated by the payback on the yen borrowing rate. Don't forget there'd be a bit of banker margin. You won't get that exact rate, even if you're institutional, if you're borrowing in the yen. So that is your third, the yen trade unwind. Further to which, as already mentioned, your bonus reason that has come in has been a number of cuts being confirmed, which is highlighting, and remember, the central bankers are late. They are always late. They are nearly always late. Let me not say 100%, but typically they're late. In short, you're already in deep trouble and it's worsening by the time they start showing up with the first bucket of water. Your hair is on fire, your clothes are on fire, your house is on fire. Most things are on fire. They've already gone, is that smoke? Interesting. I wonder. Let's wait and see. They've done that already for a number of days, weeks or months before they show up with the first pail of water and before they go, oh my God, this is bigger than I thought. Someone call a fire engine. That's kind of how it works. I am watching your comments stacking up as they show on my little foldy things. Thank you very much for participating. Delighted to have you. We have over 150 people in attendance on this live stream. By the way, tomorrow, listen to me now, tomorrow we will be doing a deep dive of the trades that are possible in this environment. Remember, bad news is also good news for traders. Things sell off faster than they go up. There are real opportunities for wealth building, and we will be analyzing those trades as they come right the way through tomorrow morning. Right here, we're on Panama time at the moment. You'll be able to purchase for a trial experience with us for $195 at attendance to trading day, which will give you an hour and a half of traditional markets, equities, FX, you name it, everything we like and can trade. And on top of that, you will get an hour and a half on crypto, where we look at Bitcoin, the altcoin markets, the total markets, and determine when and where are the best entries to be had. We'll be talking about gold, we'll be talking about silver, and right now, why don't I, as a bonus gift for you, have a look at the oil markets as well. So part of that trading day experience is you will get to experience being a community member for a couple of hours. You'll get a chance to hear and see and ask questions and engage, see how we analyze the market, see what we're currently looking at, see how we implement HVF method, Hunt Volatility Funnel method, in the practical trading markets to try see what the internal guy that has the knowledge is signaling. And we follow their money, not what they say, what they do. And it shows up in the money. That's right. And a big move is coming for oil, and you will be able to see and monitor that with us. If we go into an outlandish sell-off, which is very negative for the economy, this could indeed be a downside trade, and we will be shorting oil. And no amounts of cuts of production, although it's important to say Russia and OPEC, the expanded OPEC, kind of OPEC Plus, and the Saudis are cooperating a lot more than they were during CV19, when they all wanted to guarantee a minimum amount of money, and they just pumped a little bit more oil when the price went down, that you ended up with a super glut. And our first, well, it's our second major call on oil came in with oil trading single digits. This could indeed be a tiny inflection point. Is it going to go up? Or will it just temporarily pause before selling off to go to the low 50s and potentially even overperform into the 40s? If we are going to have an accelerating demand-destroying event, it is indeed possible. However, we have our perpetual bombers and genocidal nation that is ready to start a new war on the borders to the north, having not done enough for the south. There's always a terrorist somewhere that needs bombing, and that could, of course, at the same time lead to oil going in exactly the opposite direction. So we'll continue to monitor this on the market. Remember, geopolitics, they will distract you at the time of crash with all forms of other things, both social, geopolitical, false flag attacks, and many more. Let's have a look at some of your questions. Much love, Francis and the Market Sniper team from the great state of Texas. Hey, welcome, Texas. Glad to have you in the house. Those are our men, freedom-seeking Southerners. I'm bullish crypto metals and bearish stocks currently, says somebody else. That is Bird Brain. With that name, you sound like a contraindicator, but no, I'm sure that's not the case, that you're pretty smart. Listen, yes, we will be doing an underlying look at the general indices tomorrow, by the way, to get our overall take. Funnily enough, if it turns into an absolute rolling contagion of shock and horror and crushed despair, we could have all forms of things going down, not just the oil market. However, there are some things that are counter-cyclical which will go up as well. By the way, gold as well has been doing rather well. And I did also mention Trump, and I said I'd say something on Trump, who most now will expect fist-waving, fighting, defiant, despite assassination attempts. Now, if he was for real attempted to be assassinated, you should actually think that those people that dang goofed so badly could only trim his ear, will be trying again. But amazingly, I expect no further efforts or attempts. And in actual fact, I expect him to come almost on a landslide into the parliament, which will probably further prove the point that this was a galvanizing event to get the engaged voters behind him. Anyway, who knows? I could be wrong. We can only guess from afar. I just lone gunman patsy stories, even though people have admitted now there's more shooters, etc. It doesn't smell right that they couldn't kill one rather large chap with blondie grey hair with multiple shooters. Believe you me, they had Kennedy as a dead turkey long before they stopped the car and he got the headshot. But anyway, all those conspiratorial things aside, all those stories and narratives aside, Trump will come in on my guess. Hey, we could be wrong. A lot of people whispering this election won't be allowed to happen. It seems to be quite a whisper. Maybe they know something, just like the assassination attempt that was flagged a fair amount as well. But on balance of probabilities, I see him getting in, and I see him inheriting a very, very poisoned chalice. Here's your glass of wine to drink, sir. Everybody has peed and puked in it, and you can drink it down with a smile. That is what he's inheriting. The state of the US finances is absolutely deplorable. The ability to move, the ability to make long-term tax cuts, the ability to sustain any form of stimulus is very, very unlikely. Don't forget, if they want to do things to get a biometric ID imposed, they're going to use a right-wing guy, where everybody thinks their guy is in charge. That's right, they'll use a right-wing guy. The right is highly engaged and watching real close when the left is in power. They go a bit to sleep when their guy's in charge. And he will say, we have to stop these immigrants. We need to deport them. We need an ID, all our legitimate American citizens. If we have an ID for you and you get stopped, you just have to show your ID and you don't get deported. All these other guys, we can deport them, put them on a plane. And that'll be the excuse for getting in the digital ID that they so need to move you towards the tokenization world that little Finkelstein, Larry Finkelstein of BlackRock with the cube on his head, the black cube on his head, the zeppelin of destruction, the dark star that is hoovering up American assets and owning up all your oligarchical megacorps, all your statist companies. Government is the spender of last resort. The NFP tomorrow, live trading day tomorrow. Watch it with us, guys. Watch it with us tomorrow. Be part of us in our community and watch it happen. That number that often leads the direction of the market for a while is typically news driven, and they utilize these events. We call it the great fake number. Don't worry, it'll probably be restated downwards in a few months' time, but nonetheless, it will dictate the moves of the moment and the likely trends. What could happen is if we get further weakness, it may not, in the normal environment, bad news is actually good news because it leads to rate cuts, and good news is good news. When you get to this teetering point where there's real fear, Bad news is bad news, and good news means, well, it's pushing out the rate cuts. It's bad news too. So you do get a certain window where the whole thing inverts, and we'll be seeing exactly how the market chooses to react to the fake number, the birth-death number that will come in terms of unemployment. By the way, many of these jobs, if you take out, I think it was tourism that gets a bit of a subsidy, which is included for some reason. Daniela DiMartino Booth was rolling up one particular industry with government and got to 81%. And I can't quite remember her reason, so sorry, I'm a bit half-cocked on this one. But when included with government, which is public sector, 81% of the employment number was this industry and government public sector employment. Those are not value creators, those are value destroyers. They demand salary, they demand pension, they demand perks, and they create no alpha and they pay no big corporate taxes. They don't pay much income taxes. They don't do much in terms of contributing to the income. They just add deficit, fixed cost. And that is the big law of the land. Public sector workers, adding of public sector workers should not be in any labor related. It should be private, non-farm related sector workers only. And in actual fact, government sector workers should actually count as a negative worker and should eliminate a private sector job. That is my personal take. If you are sincere about doing taxes and having real aspects of your labor market, but they need that. The great lie, they told you it was no recession, by the way. They told you it was no recession because of strong labor market, which was nothing more than a leftist government hiring 87,000 new tax collectors, transgender consultants, and various other non-jobs that are all working actively against you. Let's have a look at some of your comments. While you contemplate, and click the link below, currently being shared, for experiencing our live trading day, which trades are going to work strongly for you in this environment where you might get fast moving markets. Don't forget, you got a clue. You saw we don't like the copper miners. You could be having a look at those various copper miners with us, who's in structure. You'll be able to see oil and oil related services companies with us during the traditional market. We will be looking, is it up or is it down? What are those equities looking like? And then we'll be moving over to Bitcoin, Sol. Could they be contraindicative? Could they be like gold? Could they go up on the possibility of treasuries being destroyed? That is going to be super interesting. Let's have a look at some of your comments while you click that link below and select your chance to join us tomorrow morning for the live trading day and the number coming in. It wasn't a recession because they didn't announce it was. That's right. Hit the like, guys. Yes, thank you very much. It does help fool the algorithm. We have 182 of you on. Where's everyone gone? You can't all be on holiday. Thoughts on FCX? I'm not sure about what you're talking about. Starmer already talking about controlling movement of the far right. I saw that clip. And of course, hate speech and far right. This is the new cultural Marxist controlling mechanism. Expressing your view against a deeply Marxist leftist agenda that is forcing wokery on you means you are a far right radical. Pre-crime means you should be monitored, surveilled, and potentially in the future arrested in advance of doing something that they, computer model and AI suggest you might do. You might do it. I know you might do it. It was one of you guys. You might try shoot Biden. In actual fact, if someone were to shoot Biden in 1 year, I would expect the round to come out the other side and with no blood at all. It's just how it is in there. It would be a space invader, I would expect, were you to do it. But you see, we just mentioned a thought. That means we discussed and openly convalesced and spoke and conspired about the assassination attempt of a leftist governor. You see, we are already guilty by association. The mega computer is listening and subtitling our words and codifying and listing. You've all been put on a list. Bad. Bad. Computer says bad. Computer is watching you. Come and join the rest of us bad guys seeking liberty and freedom, trading live with us, assessing the markets, traditional markets. That's right. On the link below. Join us. Come and have a great time. By the way, buy 3 for the price of 2. 3 months worth of access to the recording instead of just the single month. And you'll enjoy it, you'll love it, and we will take you through the next quarter of every major move with the data transition. And actually, when markets get scared and they sell off, it's great opportunities. It's great opportunities to make quick money on fast-moving breakouts to the downside where you have very tight risk and expansive rewards available to you. Plus, certain things do go up. There will be real trading opportunities. We'll be talking about that and more, and the macro markets tomorrow. Don't forget to join us then. Till next time, you have 3 indicators plus the central bank's bonus point cuts of interest rates that have been done by both the Bank of England and the forthcoming promises thereof for September by the Fed. You have the 3 indicators as to why we are likely to go into, we already are in a recession, we always were, in my opinion, a deepening of the recession, and you will get the name for this economic crisis in due course. Till then, we'll catch you later. See you on the live trading day tomorrow. This is Francis saying goodbye, keep well, love you lots, stay safe.